So the first question is regarding convertible debt with warrants. Convertible debt is when you have a debt and the person that gave you the debt has rights to convert the debt into common shares, most likely at any time that they wish before the expiry of the debt. Under IFS and ASPE, the method that's used to value them is the book value method. So the equity is issued on conversion as the book values of previous amounts, with the debt and equity portion being accounted for separately. Warrants, because we're talking about convertible debt with warrants, are valued separately into the equity portion of the transaction. So when I'm saying equity portion and then that portion, it's the equity portion of your transaction is everything that goes into your contributed surplus. And the debt portion is anything that goes in the bonds payable. So for your issuance of the bond, so the first day when the issuance is made, you're going to have a debit to your cash. So anything that the bondholder pay, well, I'm saying bondholder, but anything that the debtor paid you for the bond, so the cash you received, you're going to have your contributed surplus conversion rights, which is going to be a plug amount that you can find at the end. If it's mentioned in the question that there are detachable warrants, you're going to put them in the contributed surplus detachable warrants account. And to calculate them, it's the number of bonds times the number of detachable warrants per bond times the trading price of the warrants at issue date. And then your bonds payable is your issue price of the debt at like you did in chapter 14, it's like your present value of the debt. So the reason why it's not the same thing in cash is that the debtor is paying a premium on your debt to have the right to convert it at a later date before the bond is due. So that's why this amount and this amount, like your cash amount and your bonds amount, are not the same. The difference is going in your equity. So that's the equity portion of the debt. If time passes and the debtor has not exercised the rights of warrants or conversion, then you're going to debit your bonds payable from other book value. So your bonds payable are at zero, you don't owe anything. You're going to debit your contributed surplus for conversion rights and detachable warrants at the same amount as issuance. And you're going to put your cash amount plug, so the amount you paid. If there is a conversion of the bonds, let's say in common shares, which is most likely what's going to happen on your exam, your bonds payable are going to debit to your book value at the date of conversion. You're going to have your contributed surplus conversion rights, which is the same amount as issuance. And common shares is basically just the sum of the two amounts. If they say that and like 3% of the holder of the conversion rights decided to convert at a specific date, then your bonds payable and your contributed surplus, instead of having the book value amount at issuance, you're just doing these two values times the percentage mentioned, so times 35% in my example. For the exercise of warrants, your cash amount is amount of the bonds, amount of bonds, amounts of warrants per bonds, purchase price of shares. So everything multiplied together. Your contributed surplus is the same amount as issuance, the amounts that you found here. And then common shares, you plug it to the sum of the two other amounts. That's the same thing if they're telling you a percentage, you just do the percentage times these two amounts in your transaction. If you, the company, decide to convert the bonds early, so you're paying, let's say 50,000 to the bondholders to say like, can you please right now convert your bonds so I don't have to do it at a later date. It might be because your financial, like your share value or other factors are are good or bad and you don't want to wait at a later date, you want to do it right now. So you're gonna, under ASPE, there's two things. You're gonna first have an expense that is gonna be the market value of your debt minus the book value of the debt, and that difference is gonna go into the expense account. And then any excess, so let's say that the expense was $5,000 and you paid them cash $15,000, the $10,000 is gonna go as a debit to the retained earnings. So you're diminishing your equity. The transaction is bonds payable with a debit as a debit and your book value. You're gonna have a contributed surplus, conversion rights, issuance amount, warrants detachable, issuance amount. So the same thing as the first transaction we saw earlier. Your debt retirement cost is the market value of your bond, of your debt, minus the book value of your debt. Retained earnings is the cash that you paid minus your amount here. Cash is normally mentioned in the question. And then common share is your bonds payable plus conversion rights plus warrants detachable. So these three, well, these four are linked together, and these three are linked together. And then for IFRS, they don't put it as an expense, they don't put it in retained earnings, they put it all, the amount that you paid, in loss on retirement. So you're gonna have your bonds payable, book value, contributed surplus. The loss on retirement is the amount that you paid, cash is the amount that you paid, and your common share is the same amount. So before I move on to the problem, any question on the theory part of it? All right, so ABC Limited issued $501,000, 8% 10-year convertible bonds on January 1st, 2021 at 95. The bonds were dated January 1st, 2021. Interest is payable on December 31st, 2021. Each bonds are convertible into 15 common shares, each trading at $20. ABC Limited has decided to issue detachable stock warrants at the rate of 12 warrants for each bond. Each warrant allows the holder to purchase one common share at $50. Similar warrants are being traded at $2 each. If the bonds weren't convertible and didn't have warrants, they would have sold for $92. ABC Limited uses ASPE and records both liability and equity components. The amortization of bond premium or discount is done using the straight line method. So first requirement is prepare the entry to record the issuance transaction on January 1st, 2021. So that transaction is the same one that we did here. So I'm just gonna copy this and put it here. So your debit amount, your cash amount. So how much cash did you receive? It says that first you have to see how much is the issue price, like normal price of the debt. So you have 500 bonds valued at $1,000 each. So you're going to do 500 times $1,000, and they were issued at 95. So it's 95% of their value. So 475,000. Your conversion rights, we're going to find them at the end. It's your plug amount. The detachable warrants. So what do they say about those? They say that at the rate of 12 warrants for each bond. So the number of warrants is 12 times 500 bonds. And then we need to find the price of each of them. So each warrant allows the holder to purchase one common share at $50. That's not what we're looking for. And they're being traded at $2 each. So we're going to do times $2. So the value of the equity for the warrants is $12,000. And then your bonds payable is going to be 500 bonds times $1,000 each. And if there wasn't contributed surplus, it would be sold at 92. So times 92%. So for $60,000. And then you plug your conversion rates. So 475 minus 12 minus 460. That gives you conversion rights of $3,000. So that's it for the issuance transaction. Requirement 2, assume that on December 31st, 2022, 45% of the warrant holders exercise their options. Prepare the appropriate journal entries on December 31st, 2022. So that was our exercise of warrants here. That's the transaction. The cash amount, so how much cash did you receive? Because they paid for the warrants, they gave you cash for the warrants. I'm gonna put here like the detailed calculation because I think it's gonna be easier. So 45% of warrants are exercised. So first you want to find the number of warrants for that debt. So we have 500 bonds times 12 warrants per bond. So that gives us 6,000 warrants. Then 45% of that is 2,700. So that's the number of warrants exercised. And then the cash proceeds is this amount times $50, right? Yeah. So because basically what it says here is that they're using their warrants to buy the common shares at $50 per share. So you do the number of warrants that were exercised times the value of one share. So your cash is 135,000. Your contributed surplus, detachable warrants is the 45% of the contributed surplus that we found earlier, so of 12,000. That gives us 5,400. And then common shares is just the sum of your two debits. So that gives us a common share of 140,400. I'm practicing my numbers tonight. All right, so that's all for requirement 2. Not as bad as maybe your assignment if you had a similar question. Then for requirement 3, assume that on July 1st, 2023, 10% of the bondholder exercised their option to convert the bonds into common shares. Common shares were trading at $30. Prepare the appropriate journal entries on July 1st, 2023. There's just a question on the chat. Can you repeat how you got the 5,400? Yeah. So anytime they're telling you that there's a percentage of warrants or convertible debt that was done, you take the amount in your issuance transaction. So in this case, it was 12,000, and you time it your percentage. So it's 12,000 times 45%, and gives you 5,400. All right, so for requirement 3, the transaction it's under ASPE. It's this one here. Doesn't matter if it's under ASPE or IFRS. So you want to find the book value of the bonds payable first. So we're gonna, and something important is that they use the straight line method. They don't use the equity method. I don't remember, there's something else, but they don't use the interest expense. It's always the same amount every interest period in the interest expense. So to find it, you have your future value of the bonds. The maturity value is 500 times $1,000. So 500,000. Then you have the carrying value on January 1st, 2021. So that's the amount that we put in the bonds payable on the issuance transactions. That was 460,000. So the difference between the two is the discount. So it is 40,000. And then you do that amount divided by the number of interest periods. So in this case, it is a 10-year convertible bonds, and interest is payable on December 31st. So they're only paying interest one time per year. So you're gonna do 40,000 divided by 10 years. That's the amortization amount that you're gonna increase your bonds payable by every year. So on January 1st, 2022, your carrying value should be the 4,000 that we just calculated plus $460,000. So that gives us 464. On January 1st, 2023, it gives us 468. And then the date is on July 1st, 2023. So it's not going to be the whole 4,000. You have to take into consideration the number of months that have passed in 2023. So that's January, February, March, April, May, June, 6 months divided by a whole year, 12 months times $4,000, and then plus the amount that was in the books on January 1st, 2023. So that's your debit to the bonds payable. That's your book value. Your conversion rights, it's going to be the amount that you put at the issuance, 3,000 times the percentage that has converted. So that's 10%. That gives us 300. And the common share is just the sum of the two. So $470 and $300. And then final requirement for question 4, how many shares have been issued from the bond conversion on July 1st, 2023? So we know that we increased our common shares by this amount. And it is telling you somewhere that it's telling you in requirement 3 that on July 1st, 2023, the common shares were trading at $30 per share. So you just have to do this amount divided by 30, and that gives us, we're just going to round it up to 15,677 shares. Any questions on question 1 or the theory regarding convertible debt and warrants? I think that has a no. Can you repeat 4 again? Yeah. So they're asking you for how many shares have been issued. Since the common share amount that you calculated here was a plug number, you don't know the number of shares. So you take this amount and you divide it by the unit price of the shares on that day. So the unit price was $30 per share. So you do this amount divided by 30, and it gives us 15,677 shares. No problem. All right, so question 2, derivative. You might have some questions on it. It might be 1 or 2 in the multiple choice. I wouldn't focus too much on it. Maybe focus more on convertible debt when you're studying, because you might have more, maybe a long problem on it or something like that. This is important, but I would say not as much as convertible debt for chapter 16. So derivatives, basically they create rights and obligations that have the effect of transferring between parties the instrument one or more of the financial risks that are inherent in an underlying primary instrument. So what does that mean? Is basically you have an agreement with another company saying, hey, can I buy your shares at $30 and whenever I want until like March 2023. And then on March 2023, if that doesn't happen, then it's my loss. So the underlying primary instrument in that scenario is the shares that you might buy, and you don't know if you're going to buy them or not yet. So that's the financial risk. And also financial risk is that the shares, if you buy it from $30, they might be worth on the market like $15 in March 2023. So that's why you're not going to exercise your derivative rights. But they might also be worth, I don't know, a lot more. So you're going to have the value of like $50, but you only paid $30. So that's the attractiveness of derivatives. So there's 3 little characteristics to derivative, is that their value changes in response to the underlying instrument. So the value that you put in your books is going to be relied on the fair market value of the instrument. So let's say your shares are currently trading at $30 and you're going to change the value in your books so that it reflects that. And they require little or no initial investment. So you're not going to pay like $1 million to have a derivatives in your book. You might pay like $1,000 or $2,000. You're not paying a big amount. And the third is that they are settled at a future date. So examples of derivative warrants, which is the warrant in the past question, that's a derivative. There's also call option, put options that you might have seen come through it if you took the class. I just put a little description, but it's not that important. So at issuance, so there's two people in the transactions. There's the holder, the person that says, can I buy them at $30 in 3 years? And there's a writer, is the person that is gonna let them buy the shares at $30 in 3 years. It's not the writer is not necessarily the person in the company that has the shares. It might have been like a financial advisor that's selling you the shares for that price. It's not linked to the common shares of the company, let's say. So at issuance, the holder is gonna put the amount, if they paid something to get the, let's say I'm going to use option in this case instead of derivative, it's just easier to say. So if they paid an amount to have an option at issuance, let's say they paid $500, then they're going to put that amount into a financial asset. If they say that they enter into a contract or something like that, but they didn't pay anything, at issuance, you're not going to have any transaction, it's just zero. And then you're going to value them when you get the fair market values of the option in the problem. So at issuance, holder put in the asset, cash, amount they paid. And for the writer, it's cash, amount they received, and a liability. So something that they're going to owe the holder. When the fair market value changes for the option, the holder, if they book it to the loss if the value in the market is less than the amount in their books. So they want to bring it down to the market, to the value on the market. And they book it to gain if the amount, well, the value is greater than in its book. So they want to bring it to the market value again. So it's loss, amount in book minus fair market value, and then you credit your financial asset, amounts in book minus fair market value. And that decreases the value of the financial assets to what's on the market. And then the gain is just same transaction, but reversed. The writer, when the holder has a loss, the writer has a gain. When the holder has a gain, the writer has a loss. It's always the same amount for both parties. It's just that one has a loss, the other one has a gain, and vice versa. So for them, if the value in the market is greater than the amount that they have in the books, then it's going to be a loss and they're going to increase the liability. And if the value in the market is smaller than what they have in their books, then they're going to decrease their liability and plug it as a gain. When the holder decides to exercise their rights to buy the option, then on their end, they're going to book an investment of the number of shares on options. So normally, they're going to tell you in the problem how many shares they have agreed on to buy, and times the market price of the shares. So not the market, not the price of the shares on the option, the price that the shares are currently trading on the market. Might be a loss, might be a gain. I just put them both there so you can plug them. Your derivative assets, so it's the book values on that date for the holder. And then you have cash, which is the number of shares on option times the strike price, so the price on the option. And then you have loss or gain depending on which one is bigger. For the writer, what happens here is that they are receiving the cash from the holder, but then they're paying on the market the price market for the shares that the holder is buying. So there's like two transactions. So the first transaction is the money that they're receiving from the holder. That's going to be the number of shares on the option times the price on the option. And then liability, same amount. And then for the second option, when they are buying the shares on the market to give them to the holder, they're going to debit their liability amount that they have in their books. They're going to credit the cash, so the amount that they pay, so number of shares on options times the market price of shares. Then it might result in loss or gain. If the holder cash their options without taking the delivery of the underlying financial instrument, in this case shares, then the holder is going to get cash from the difference of the market price minus the strike price times the number of shares that they agreed upon, and they're going to credit their financial asset for its book value, then plug it as a loss or gain. Then for the writer, liability is the book amount, cash, same amount of cash that you calculated for the holder, and then it's a loss or a gain for them. So I know it seems like complicated, but it's just reducing your liability or asset to the market value. And then at exercise date, you just plug them in the transaction. Any questions for derivatives? No? Okay. So ABC Limited purchased a put option on Tesla common shares on September 5th, 2021 for $570. The put option is for 653 shares and the strike price is $25. The option expires on March 1st, 2022. The following dates are available with respect to the put option. So then they give you different dates with the fair value of the option and the market price of the Tesla shares on these dates. So they're asking you to prepare the journal entries for each of the dates. So for the first one, it's on September 5th, 2021. Invest in put options on Tesla shares. So it's going to be your put option and cash. How much did ABC Limited pay? On September 5th, they paid $570. So that's what you book, and that's it. On September 30th, 2021, we're going to look at the fair value of the option on that date. So it was $250. You have in your book $570. So you want to come and reduce the amount that you have in your book so that it equals to $50. So it's going to be a loss. And you're going to credit your asset to reduce it. Your loss is the amount that you have in your book right now, which is $570, minus the fair value of option $250 because you want to reduce it to that. So your loss is of $320. On December 31st, 2021, the fair market value also decreased to $100. So your book value is $250 right now and decreased to $100. So you have a loss of $150. And then 150, 150. And then on March 1st, 2021, the value is 0 because that's the date that they expired on. So you're going to have the loss of 150 to bring down your asset to 0. Yeah, that's about it. I could add a requirement. So let's say that instead of expiring on March 1st and they haven't done anything, ABC Limited, in regards to their put option, let's say that they exercise the right on December 31st, 2021, like what would happen? And I have the market price. So I have everything. So they would have had exercise on December 31st, 2021. They would have had an investment of 653 shares times the market price of $29. They would have had would have had, I'm just going to copy this because it's easier. I don't know them by heart. It would have had a derivative cash. They would have paid cash 653 times $25, which is a strike price. They have a financial asset of $100 on December 31st. Yes, you're right. You're right. It's $100. It's a loss of 100. Thank you for correcting me. And then you're gonna have a loss of this amount minus this and this. So you have a loss of $2,512 if they exercise on December 31st, because the market price is $29 and then the strike price is $25. So their strike price is lower than what they're trading on the price on that date. All right. So question 3. So that's pretty much it for chapter 16. You might have seen something with like rates with the US and Canadian dollars. That's basically the same thing as here. You're bringing it down to put it at the market value until you exercise the rights. And yeah, so just for chapter 16, there's this aspect, but really focus on convertible debt. That will definitely come up in your exam. Question 3 is about premiums, which I haven't covered in chapter 13. So premiums is a free offer with sales. So you're a company, you offer your clients a puppet after when they buy $100 worth of shoes in your store. So how do you account for that? You have first to estimate the redemption of the premium free offer. So how much do you think people are going to redeem, and put a dollar value to it? That's going to go in your liability. And then the actual amount of the premium. So then you reduce your liability and you credit the inventory of the premium. So in that case, I would have credited the inventory of the puppets. I like to make a little table when I do these types of problems, because there's a lot of information. You're like, where do I put them? So I just find it easier. Also, there's two ways, like the warranties, to account for premiums. There's a way that you expense it when you sell your premiums. There's like the expected amount from your sales that you're going to think is going to be redeemed for premiums, you expense it right away. Or there's the way that you put in unearned revenue, and when they're actually buying the premium, then you expense it. So like the expense approach or the revenue approach with the warranties, it's the same type of logic here. So for question 3, at the beginning of 2021, ABC Limited started a sales program for its coffee. Its customers had a reward card, and each time they bought a coffee, a stamp was applied to their card. After 10 coffees, the customer could buy a mug for $2. ABC Limited estimated that 65% of the cards circulating would be redeemed. During 2021, 13,750,000 coffee were sold, 700,000 mugs were purchased, and 800,000 cards were redeemed. During 2022, 15 million coffees were sold, 920,000 mugs were sold, and 875,000 cards were redeemed. ABC Limited held 350,000 mugs in inventory on December 31st, 2020 at the same cost. The only requirement is prepare the appropriate journal entries for all transactions stated in the given problem for the years 2021 and 2022. So a lot of numbers. So I'm gonna first put them in my little tables here. So the first, like chronologically order, is on in 2020. We know that the premium inventory was of, which is the mugs, the premium is the mugs, was of 350,000. And that's the only information we have to for 2020. For 2021, it says that 13,750,000 coffees were sold, 700,000 mugs were purchased, and 800,000 cards were redeemed. So your premium inventory, they say that they purchased 700,000 mugs. So they purchased 700, so that increases their inventory. The expected redemption is going to be your 13,750,000 coffees divided by 10 coffees, so that's when they can redeem their cards, times 65,000. So $893,000 and units, and in dollars, it's going to be this amount times the value of the mugs, which is $2. Hold on, I'm just going to close my Facebook. You know, it was open. I don't know where it is. All right. Okay. So that's the expected redemption. So that's when they're selling their mugs, their premium. They're expecting during the year 2021 that it's going to be around $1.7 million. They're saying that actually 800,000 cards were redeemed. So the actual was 800,000. And that in money is 1.6 million. So your liability is going to be at the end of 2021 is going to be your expected minus your actual. We're going to put them in transactions when I'm done doing the little table. So that starts, so minus 800. So 800,000, yeah, 800,000 cards were redeemed. So that means 800,000 mugs were sold. So that diminished your inventory. So on January 1st, 2022, you have an inventory amount of 250,000. In 2022, what happened? They expected, well, we'll do the expected redemption. It was, they sold 15 million coffees divided by 10 coffees times 65%. The amount in dollars is this amount times $2 per mug. They bought 920,000 mugs. So that increases their inventory of mugs. And 875,000 cards were redeemed. So the actual redemption is this amount. And in dollars, it's 875,000 times $2. So the balance of liability is whatever you had last year, plus your expected redemption in dollars, minus your actual redemption. So at the end of 2022, they would have a balance in liabilities of $387,000. And then you can put they reduced their inventory by 875,000. So that gives them a final inventory of 295,000. So for the entries, first we can put that they bought the mugs by mugs. So it increases their premium inventory. And then they either paid cash or on credit by accounts payable. And the amount was 700,000 times $2, because it says that it's the same cost as what they sell. So it's 1.4 million. And the expected redemption. So whenever they sold, well, I'll do the revenue first. So I didn't put in the problem like how much a coffee costs, because no, it doesn't matter. Never mind, I didn't say anything. I'm getting myself confused. Okay, so you're gonna put your expected redemption for the premiums for the year. So that goes all in your expense. And then it's your liability for premiums. And that's the amount right here, the 1.7 million. So you increase your liability by your estimate. And then when there's the actual redemption, you're gonna have your liability for premium and your premium inventory. And it's gonna be your 1.6 million here. So that's it for 2021. Basically what it does is that it increase and then it decrease your liability premium. So it gives you a balance on December 31st, 2021 of $187,000. That's for 2021. For 2022, you're gonna do exactly the same entries, but now with the amounts that we calculated earlier for 2022. So the premium inventory, it increased by, how you got that 387,000, where did I get it here? Here, oh. Yeah. So it is the balance and liability in the last year on December 31st, 2021, plus the expected redemption for 2022 minus the actual redemption for 2022. And that gives us the $387,000. We're gonna do the entries right here. So your premium inventory increased by 920,000 times $2. That's the same thing here. Your expected redemption is $1.9 million. And then your actual reduces your liability premium of 1.7 million. And that's all the entries for 2022. Any other questions for question 3? Right, I'll move to question 4. It's going to be a short one. So question 4 is about contingent liability. So it is where you have a certain situation that's arising in your company, let's say a lawsuit, and you don't really know how it's going to end up yet. And so you don't know if you should account for it in your financial statements at the end of the year. ASPE and IFRS have different criteria as to if you should account for it or not at the end of the year. For ASPE, there should be 2 conditions for sure that need to be met. So it's likely that the event is going to happen. So it's 70% if you want to put in numbers. And that the amount of the loss can be reasonably estimated. So that means that in the problem, they should give you a number or a range, or it should say like, okay, we think that it's going to be this amount. If the amount is given in a range, you choose a lower value for ASPE because you want your liabilities to be as low as possible. And in your notes to the financial statements, you're going to disclose the excess of the range. So you're going to say, let's say the range is anywhere from $4,000 to $10,000. You're going to put in your financial statement $4,000. But then in your notes, you're going to say like, it might be $10,000 instead of $4,000. We don't know yet. And then anything that from that amount, you put it as loss and then liability. For IFRS, it's if it is more likely than not to occur, so it's 50% or more. It's they should give you a point estimate. If they don't give you a point estimate and give you a range with probabilities, you do a weighted average. And it's the same transaction as for ASPE. So for question 4, a customer of ABC Limited filed a lawsuit against ABC Limited following an accident where the ceiling of the store fell on him and injured him. The attorneys of ABC Limited, after careful review of the evidence, were of the opinion that there's a probability of 80% that ABC Limited will lose the case. The attorneys presented their assessment of possible outcomes along with estimated probabilities. However, they refused to give a precise estimate as no amount is that likely to occur. My grammar is poor in that question, but I think you get the point. So then they give you a range with the percentage of probabilities. And then for the requirements is determine the amount of liability, if any, to be reported under ASPE, and prepare the relevant journal entry, if required, to record the liability. And the second requirement is the same thing, but for IFRS. For ASPE, we said that to record a contingent liability, 2 criteria. More likely, it's likely that the event will happen, 70% or more. In this case, it's 80% or more, so that works for the first one. And the amount of the loss can be reasonably estimated. It works here too, because they're giving you a range. As I mentioned, under ASPE, if they're giving you a range, you choose a lower value. So here the lower value is $500,000. So you're going to put a contingent loss of $500,000. And then a contingent liability of the same amount. For IFRS, it's more likely than not to occur, 50% or more, so that works. And if there's a range with probabilities, then do the weighted average, so that's what we're going to do for the amount. So it's the same transaction, contingent loss, contingent liability, and then for the weighted average, so $500,000 times 11% plus $560,000 times 15% plus $610,000 times 20% plus $650,000 times 25%, $690,000 times 16%, and $720,000 times 13%. So it should give $627,000, 500. Does anyone else have the same amount? Just to make sure I didn't do this wrong. I think I'm good with my math, but if I'm in a mistake, let me know. And that's it for contingent liabilities. And then finally, the last one is settlement of debt with a transfer of non-cash asset. So we did a problem similar last week, but it was with a building. Now we're doing it with shares. So it's the settlement of a debt with the issuance of shares. So the market value of the shares is issued is compared to the book value of the debt retired, and any gain or loss is recorded. So for ABC, oh, I didn't even read the question. ABC Limited has asked its bank if they could sell their $400,000 debt. The bank has agreed, but in exchange, they're asking for 20,000 shares of ABC Limited with a market value of $390,000 to settle the debt. So they're asking you for ABC Limited transaction. So they're gonna debit their long-term debt, get rid of it in their book. It says here that it's $400,000. There's gonna be a gain or loss, and then they're issuing common shares that have a market value of $390,000. So they have a gain of 10,000. For the bank, they're gonna gain an investment with the shares of 390,000. They have the loss on settlement of $10,000. And their debt receivable is credited of $400,000. And that's it. That's all the problems I have for today. I'm gonna share, does anyone have any question on this? If not, I'm gonna share, you know how I do like little theory here? I'm gonna share my screen with my notes, with all of them combined. So you guys can take pictures of them and you can reference them. Only thing I'm gonna say is a lot of stuff is in there, but not everything. So do practice the problems that have been assigned to you. And if you guys have midterms, like past midterms on Moodle, do them too. It's really useful. A lot of in the past, they always did multiple choice questions. So you get an idea of how it looks. So you can continue. I'm gonna stop the recording. Whoops.